presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for January the 20th, 2026. I'm Mo Ansari, President of Compact Asset Management. Thank you for joining me today. Let's start with, first of all, remind all of you, click on the subscribe button so whenever I do an update, you'll be notified. Also, you can go to compact.com, click on Insights, and you can get the podcast, which is a much longer version of this YouTube update with Javed, and we talk about a lot of different things. You can go there and listen to those. All of those are there. If you need help with your portfolio, send me an email at invest@compact.com or 800-388-9700. Just give me a call. Now we'll be more than happy to help you set up your portfolio, make sure it's got the right allocation, make sure you're headed in the right direction. Let's start with the numbers. Last week, markets lower. S&P was slightly lower, down 0.36, but you've heard me over the years. Long weekends cause turning points. I don't know why. I've talked about this for 30 years. I don't know why long weekends cause a peak or a bottom in the market. And today we saw a 2% decline in the S&P. Yes, we have geopolitical events with the president talking about invading Greenland or just taking it over and so on. Plus, we do have this week the Supreme Court. They're going to hear Lisa Cook case, which is the case, Fed governor, if the president has the power to fire her or not. Really, it'll set up if the Fed is independent or if the Fed is going to be dictated by politics from here on out. If we are going to get politics, I think that could be detrimental for the stock and bond market. Whenever you start putting political people running the economy, politics and economics do not mix. You've heard me say that for 30 years. It's hard to keep them separated because all of us have our opinions about politics, but we can't make economic decisions based on our political views. If you start doing that, the results are disastrous over a long period of time. That's what I've seen. Dow was also down 0.228. That's what we saw last week. NASDAQ down even more, down 0.66. But you see emerging markets were up. You saw small cap was up. So we'll have to see if these are lasting trends. When the S&P goes down, we'll have to see. Last year, when the S&P went down in last April, the Russell small cap stocks went down even more. Today was an interesting day. S&P was down 2%. Small caps were down less. That, to me, is a good sign overall. If you look at the best sector this year, it is industrials. The worst sector this year is technology. It is the worst sector this year so far. Now, how January goes the rest of the year. That's why 67.45 is something to watch. 68.45 is where we started the year. We have to close above that to get a positive January. Today we are below that. We'll have to wait and see. Looking at crude oil, it is back up slightly. Gold continues to run. So does silver. Interest rates sharply higher. And we talk about this in a lot more detail in the podcast today. Javed and I did. We talked about this in a lot more detail. What is happening? Why are interest rates going up when the Fed has been bringing rates down? Well, there's a lot of contributing factors. If you cut rates too quickly, what happens? It spikes the economy. When the economy does really well short term, demand goes up. When demand goes up, prices go up. Prices go up means inflation. And how do you bring inflation down? You raise interest rates. So if you cut interest rates too much, that is inflationary. And the only way you can bring inflation down again is to raise interest rates dramatically and put the economy in a recession. That's not good for stocks and bonds. So that's why we have to be very careful on bringing rates down that we do not cause inflation. But that is what the market, I think, is starting to worry about. What is the new Fed chairman going to do? What is going to happen to the Federal Reserve? If it becomes politicized, we cut interest rates in the short term, we could get, it's like throwing gasoline on a fire. What does it do? It goes poof. That's what happens when you throw a lot more lower interest rates on the economy. It goes poof, but it lasts for a very short period of time, and then it fizzles out. That's what we have to be careful of if we bring interest rates down too quickly, too much. Looking at rates, if you look at mortgages, what is the biggest driver of mortgages? If you look at between 1982 and 2006, the biggest part of this was the Treasury premium, was 3%. And then also another contributing factor was the spread, mortgage spread. That means how much you pay over Treasuries to get a mortgage. That went to negative between 2010 and 2019, and that took about 3% out of the mortgage rates right here. Also, we saw the spread go down from 3% to 1.6%. You can see now that spread has come back up for mortgages, the premium over Treasuries, and this has gone up. The premium mortgage spread, how much banks are charging over Treasuries. So if these Treasury 10-year note goes up a lot, it's going to push up mortgages, which is not good for the real estate market. Look at the last 25 years. What has gone up the most? Hospital services, up 275%. What has come down the most? TVs are nearly half the price of what they were 25 years ago. You can get a massive TV, $500-600 at Costco, and it is down way, half of what it was 25 years ago. But it depends on where you are in life. Toys are down 75%, right here. But if you're 70 years old, how many toys? Well, you might buy some for the grandkids, but how many toys are you going to be buying? Not a lot. On the other hand, hospital services and medical services, medical care, you could be using a lot more. So when you do a financial plan, make sure, depending on where you are, you've got to inflate these costs in those higher than inflation rates, depending on where you are in life. If you're 35, 40, 45 years old, probability is you're not going to need hospital services and Medicare in the short term, or medical care in the short term. So you can keep those lower in the short term, but you might need more college tuition. You've got to figure out. If you're 50 years old, kids are probably starting college. That's where you have to look at college tuition and figure that in. How much are you going to help the kids? So things like that, that's what we develop. Every single one of our client does not have, we have the asset management team that manages your money. You have a financial advisor that works with you. And then you have a financial planner, not the guy who's managing the money, but someone else who's looking at your long-term plan. And that is what every Compact client gets, included in the fees, no extra charge for that. Last week we got CPI and retail sales. Retail sales were good. This week we don't get a lot of data. So it's going to be, main driver this week is going to be geopolitical events, what the Supreme Court does with the Fed ruling, with Lisa Cook, and what they do with the Treasury, with the tariffs. That's what the Supreme Court could rule on that. Those two rulings could have a big impact on the market. Also, what is going to happen geopolitically? The president is headed to Davos and all the Europeans are going to be there. Are they going to sit down, try to hash out Greenland, figure something out? Are we going to be at each other's throats as far as Europe is concerned? We'll have to wait and see. I think everybody backs off from all the heated rhetoric that we're hearing from Washington and from Brussels from the Europeans. And everybody will say, okay, this is what we want to do with Greenland and figure something out. Looking at the technicals, we are down today below the 20-day moving average. We are down below the 50-day moving average, which is 68.29. We are at 6,800 just about going into the close. The next support is right here, a little bit of support, 67 and change. Then if we break 6,700, we're probably headed down here to about 6,500. That's this is one support number two, and this is support three, which is 6,350. 6,350 down from here, from 7,000 down to 60. It's about 7, 8, 9%. Painful, but that's a normal correction in the market, pullback. It's not even a correction, it's a pullback in the market. 10% or more is a correction. So that's what we have to watch on the short side. Again, we seem to, my upside target still, this was projected from year to year, 71.25 to 71.75. But again, we made a new high. We got above this high, and that satisfies wave 5. Once we complete 5, then we get a pullback, usually an ABC or wave count to the downside. So we'll have to watch how Greenland goes, how the Supreme Court goes, and that could cause quite a bit of volatility over the next couple of weeks. Support again on the weekly charts. Each one of these lines that you see is 1 week of trading. So we go back all the way to 2022, all the way back here. This is 2022, starting at 23 right here, and this is 24, 25, 24 is right here, and this is 25 right here. 2025 is right here. This is all 25 right here, starting right here. So each one a weekly chart, and then we go from there. This was April of last year to tariff tantrum, came all the way down. But this is support 6770. Break that again, we go down to about 6300, and that's on the weekly charts I talked about, is somewhere around the 200-day moving average. But we also seem to be completing. Fifth wave target was coming around here, but it doesn't mean we have to go all the way here. As long as we've made a new high above 3, 1, 2, 3, 4, 5. This is 3, this is 4, and this is 5 on the upside. And as long as we've completed 5, now we'll have to wait and see where support goes. NASDAQ gap below the 20-day, gap below the 50-day. Next support is right here, which is just below 22,000. Then here, just below 22,000 right here. And this 22,800. This is 21,700 or so, 800 or so. So something to watch. Below that, we've got support right here, 21,007. Again, we are 22.9 today. I'm going into the close. So that's a couple of thousand points. Again, 7, 8, 9%. Weekly charts, 22,795. We closed at 22.9 or 920 going into, or 940 going into the close. I'm doing this just before the close on Tuesday. So we'll have to wait and see, but this is a number I would watch carefully, 21,650. That's the dot plot. When it turns negative, when they get above the market, here's the market, dot plot is above it, you can see that we came down quite a bit when it turns negative. When it turns positive, it can stay positive for a long period of time. We turn positive here, and I talked about this, when it turns positive, usually stays positive a lot of number of weeks. Each one of these dots is 1 week, and you can see from April of last year till now we've been positive. But if you get below this dot, which is 21,650, then the market stay positive for a period, negative for a period of time. 5, 6, 7, 8 weeks is, see here, it's negative right here, stayed negative for not a long time, but here negative right here, and you can see it stayed negative for about 10, 12 weeks, 3, 4 months on the negative side. So something to watch carefully here. 10-year note, again, at 4.23 is a 200-day. We gapped above that today. This is next resistance, which is 4.35 right here. Pulling, if we get above that, then we're going to 4.5, which will be up here. Now worry about that. If we get much above that, this is the highs that we made around 4.65. If we get above 4.65 on the 10-year, that could be a major problem for the stock market. Probably then we're looking at somewhere around 7, 8, 10% pullback, at least in the market, if not more. Gold spiked up today, still looking good. As long as we're above 410, we're at 436 on the GLD, which is the ETF for gold. You can buy gold in your stock portfolio just by buying GLD. High yield bonds are holding up good. They're only down less than the bond market today. So that's good, closed above the 20-day moving average, which is good. And that tells me that long term, we're not headed in a recession. We start seeing these high yield bonds coming down dramatically, that's when we see a deeper pullback in the market. Right now, we're still above the 20-day, still above the 50-day moving average, so we're looking pretty good. Those are my thoughts, those are my observations. Again, if you would like to get a much more detailed view, go to compact.com, click on Insights. You can hear the podcast that Javed and I did. That's a longer version of what I just talked about, gives you a lot more detail. It is absolutely free. If you want help with your portfolio, go to invest@compact.com, send me an email. We'll take a look at your portfolio. It is free of charge, the first consultation. or you can just give me a call at 800-388-9700. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.